The following is paid programming.
It's time to talk taxes.
New friends, new opportunities, new partners. EG Tax.
It's Ask the Tax Lady with Esther Gulius and EG Tax on News Radio 930 WBEN. To reach Esther now, call 803-0930. Toll free at 1-800-616-9236. And cell calls are free at star 930. And now, live from the WBEN studios, it's Esther Gulius.
Hi, I'm Esther Gulius, the tax lady from EG Tax, and this is our hour to talk taxes. And unlike a lot of our shows or most of our shows, which are live phone and shows, what we do 2 or 3 times a year, we do chewing up your emails. And so what we're doing is we're actually going to be addressing some of the emails that you sent to us, and it gives us more opportunity to go in depth to the answer. So this week, no phone calls. Next week we'll be back again taking your live phone calls. And I'm joined in studio with Christopher Fabian.
Hello, Esther.
Hello, Christopher. And Tiffany Fabian.
Hey there, Esther.
And
how goes
of course,
it?
They have the same last name, and they're not brother and sister. They're husband and wife. So I'm Esther Gulius, the tax lady from EG Tax, and we want to help you. By the way, if you're getting letters from the IRS or the state of New York now, this year, kind of a new technique. I don't know if you've noticed it, Chris and Tiff, but they're like sending out partial refunds. And they might be keeping back some money, and then they ask for the proof later. So if you're somebody that's getting a partial refund that isn't a refund that you thought you were supposed to get, you will get a letter later on that says what they are asking for further proof of. If you don't respond to that letter, then they're going to keep your money, right?
Yeah, that's right, which would be shameful. So make sure you respond. If you need help responding, we're always
there.
Come
see us at EG Tax. We're open 9 to 5, Monday through Friday this time of year. We're closed on Saturdays and Sundays. If you need a special appointment, of course, we'll stay open for you or come in on a Saturday. But if you're getting letters, don't just ignore them. If you got a shorted refund, don't ignore that, because you want to make sure that you can prove what you put on your tax return. Okay?
That's right. And also now, whenever you are in the year is now a good time to plan for next year. So plan accordingly. That's
exactly right. I think that we have a commercial kind of running, Carpe Diem, seize the day. There is no time like now to tax plan for the future. And especially as all the Mr. Trump. All the Trump tax cuts come to fruition. Listen to Ask the Tax Lady, and we're going to let you know as those things roll out, so you know how to plan. But until then, if you had children that are turning 17, or you just got married, or you're getting a divorce, EG Tax wants to help you, and we don't charge to help.
And then also, as we find out about the free tuition for New York State residents, as that rolls out, we'll keep you informed.
Like I said, right now we're short on details, but we're long on the fact that we know that it's happening. Okay, so we're going to do our email, so let's start off with anybody's email.
Okay. George writes in, Esther, I inherited an IRA from my mother, approximately $150,000. What are my options, or do I have to bite the bullet and take this all at once?
Okay, so it sounds like he's the beneficiary.
Yep.
Because if he weren't the beneficiary and he just inherited it, they're different laws, right? But if you are the beneficiary, then you have 3 ways of taking it. You can take it all in the year that you get it, right? Which would make it really taxable, and it would cost you a lot of money. Or second option, you can spread it over a 5-year period.
Right.
Or the third option is you can annuitize it based upon your life expectancy. So if you want to pay all the taxes up front on $150,000, you could be looking at $50,000 upwards in taxes you'd have to pay, so you'd lose a third of it. You can take it all. Some people would take it all. It's up to you. But 5 years is is another way to do it, or annuitizing based upon life expectancy.
And this is when it's really important for you to come in and look at us, and so we can talk to us, so we can look at your tax situation, because each one of those answers has a different ramifications. So make sure, if you take it over 5 years, if you annuitize it, if you take it all, make sure you sit down with us. It costs nothing, and then you'll have the answer that you need.
And so, maybe for this gentleman, for George, if he's married, it doesn't really say, but if he takes it over 5 years, and if his company has 401ks, max out his 401k for him and his wife for this year.
Good,
this way, they take the money in one hand and put it away in the retirement.
So let's explain this for people. So let's say that George could do the elective deferral. Let's say he's over the age of 50, right?
Right.
So he could put $24,000 into his IRA, right? I mean, his 401k through work.
Right.
Well, if he took his $150,000 over the 5 years, he's going to take out $30,000. So on line 14B, he's got $30,000, but on line 7, he sheltered 24. So really, all that's going to be taxable then is 6.
Right.
And he can control the 24 then.
And another really exciting thing is, let's say George is is married and his wife doesn't work. She can put money into an IRA drawing off of his wages.
But then what happens? They just put that money back into something that, because otherwise, why don't they just annuitize it? Right?
Right. Well, they could post, depending if he just turned 50 or maybe he's 40.
Right, but that's just part of the plan.
Right.
And that's what's so cool is there's so many options and little tools in the tool chest, and it helps you to plan, right?
Yep.
And, of course, once if he did put the money into his 401k plan and the wife put it in her IRA, and at that point in time, they control how they can withdraw it, because they're back in, they'd be in control then.
That's right. Yep.
Okay, let's do another
I
one.
got Laura from Tonawanda. She says, EG Tax, I graduated from college last June. I got a great job in February. I'm done now if claiming 4 exemptions on my W-2. Is that too much? I'm living home with my parents right now. I do pay $200 a month to my student loans. So she wants to know if 4
allowances is a good thing.
Right.
Probably not.
No.
Because really those allowances are based upon the subtractions and credits that you have to offset your tax liability. In your situation, all you have is a teeny-weeny student loan interest. Well, $200 a month would be $2,400, probably very close to it. So you got your personal exemption and the student loan interest. So she might be able to get away with 2.
Right.
Maybe.
Yeah. Not on the state.
Yeah,
and then the thing is, she's living at home with her parents, so she would want to join the 401k at her new great job as soon as she can, because she doesn't have a lot of expenses right now. So,
but 4 would be too much.
4 is
She'll
too much.
end up owing, and she won't like that. So
no.
So what she wants to do is, I think, 2 single on the federal, maybe 1 single on the state, because the state has tighter withholding charts than the federal. Take a look at putting money into your 401k plan and saving as much money as you can, and buy a house at some point in time.
That's right. Absolutely. And make sure you tell mom and dad to plan on not claiming you this year too. And so that's something
right.
They have to plan.
That's exactly right. And maybe if she's going to continue graduate school, she'll be able to get the lifetime learning credit after that too. So there's all kinds of things that she can look at. I'm Esther Gullius, the tax lady from EG Tax. Normally we take your live phone-ins, calls, and we love that. But 3 or 4 times a year actually, we restrict the calls so that we don't take them on our Saturday show, and we just kind of chew up your emails, and that way it gives us an opportunity to go into more depth. And a lot of times the clients say, I really enjoy this because I actually understand how you think. And just like with that IRA, Chris was saying you could put the money in the 401k, and Tiff said the wife, if she's married, could put it in an IRA. It just goes to show you how complicated taxes are and how a good tax plan is an important thing for you. Well, I'm Esther Gullius. We're going to break for some short messages, and we'll be back on the other side with more of you. Bye-bye. Hi, I'm Esther Golias, the tax lady from EG Tax, and today we're just chewing up emails. And some of these emails that you sent us are so interesting that we devote 2 or 3 times a year to just answering these emails and going into more in-depth discussion on what can be done tax-wise. If you are somebody that has a question and you don't feel like calling us here on the show, you can email us through our website at egtax.com, and we'd be very happy to include your questions on one of our other call-in show, non-call-in shows. Of course, next week we'll be back with your phone calls. And we got what do we got here now, kids?
We've got Chris, and Chris says, "Tax lady, I owe over $40,000 in credit cards, and it's driving me crazy. I'm thinking of taking the money out of my pension so I can get out from under this big payment. How much should I withhold from the distribution?" Well, first I'd want to know how old he is. Correct, Chris?
Right, because there's the 10% penalty if you do take the money out of your pension before you're 59 and a half. So, that's the big thing, because you could be looking, say you're in the 15% bracket, you take out the money, 15 plus 10% penalty is 25%, plus New York State could be potentially another 7%. So you're looking 32%. So at $40,000, if you take that out, you're looking about $12,000 in taxes you're going to pay that you just made yourself go in debt to pay off another debt. So how are you going to pay that debt off?
And one thing I might want to say is don't take it all one tax year out. Spread it out over 2 years. So maybe take out, if you have to, if there's no other means, you might want to, if you're a homeowner, you might want to look at taking a home equity. You might want to look at some of those 0% interest credit cards. You also might want to think about asking your parents if you could borrow the money from them. But there's different options than taking the money out of your pension.
Yeah, I mean, we always suggest that if you can, look at taking money out of your pension plan as the last resort. And further, I know that nobody likes to think about bankruptcy, but you may want to talk to a bankruptcy attorney about the possibility of doing a bankruptcy, because under New York State law, your pension is protected, because that's how important the state of New York thinks it is for you to have pension money when you retire. So not only are you talking about paying 40% or more in taxes if you're under the age of 59 and a half, but you're also taking money out of your future. So you might want to look at bankruptcy as a possibility. And a lot of times people say to me, "Oh, but if I do a bankruptcy, then it's going to ruin my credit." Usually, when you have that kind of credit card debt, your credit is pretty much shot anyway. So bankruptcy is protection, and it really is something you should consider, and anybody should consider, rather than taking money out of their pension plan. It should be the path of least choice.
That's right. That's right.
Okay. Do we eat that one up enough?
Sure.
Okay. What else we got here?
Let's see. We got, I owe the IRS over $85,000 total for the last 4 years. Can EG Tax help clear up this mess? Can I really pay pennies on the dollar like I hear on TV? And this is from Jerry.
Okay, so the first thing that strikes me is that he said over several years. So it's not like somebody that just got into a problem 1 year and fixed it, right? But this is somebody who's making money and owing the IRS, and making money and owing the IRS, and making money and owing the IRS. So the first thing is I would want to say is he able to live within the terms of an offer and compromise? If they did an offer and compromise, you would have to not owe the IRS money, and you have to timely file for 5 years after the offer and compromise, or else the whole debt comes back. So he has to change the way he does business, right?
Right.
And secondly, can he really not afford to pay? Because some people just get way over their head, and they're making $100,000, $150,000, but they're living like they're making $300,000, so they're under withholding, and that's how the liability is coming about. So if that's the case, then this guy's got to have a whole alteration in his mind. But if you really can't, let's say something happened. Let's say there was sickness and you took $30,000 out of your pension plan one year, and you took out $30,000 the next year, and you took out $30,000 the next year, and that's why the debt happened. And now there is no 401k, and there's still sickness, and you're unable to pay. That's a perfect example of somebody that would qualify for an offer in compromise.
And that would be, as Jerry said, those pennies on the dollar. That's what he's talking about. And so it is potentially there. I know that at our office we have somebody who does offers and compromises. Chris does offers and compromises, and Esther does. And it's a large success often if you are a candidate, as Esther has said.
It all depends on the story,
Yep.
right? I mean, if you are just somebody who's been living high in the hog, and you just have made it so you got 9 allowances every paycheck, you're not paying your taxes, well, then it's tough. They're going to make you pay if you have the ability to pay.
Yeah.
But if, in fact, you've had a bad situation, maybe health, lost your job, you had needed the money out of your pension plan to make ends meet, then you might be a great candidate for
the offer,
and
right?
compromise.
And one thing, like going back to Chris, the previous email, and you can correct me if I'm wrong, but I believe after 3 years of having your debt to the IRS, it's eligible to be filed included in the bankruptcy.
Right. That's
So-
true. That's true too.
Maybe Jerry is behind the 8 ball on other things.
True.
I've had a client where he owed the IRS and he filed bankruptcy, and I said, why didn't your bankruptcy attorney put it on there? I didn't know he could.
Yep.
Well, so he got stuck.
That's
now.
true. I mean, the thing is, so many times, really, just good financial counseling, having somebody else to talk to. Sometimes being the captain of your own ship is a wonderful thing, but if you're going to go over Niagara Falls because you didn't know Niagara Falls was there, that's not so good. Because on this side of the falls, it looks all great. It's the other side of the falls that doesn't look so hot.
The bottom side.
And who would know that you're going that way, except that the water's getting faster,
Right. And
so it's just like that with your finances. Sometimes just getting that second opinion, another way to look at things, having a devil's say. That's what's so great about, I think, what we do at EG Tax is that you can call us and we're going to try to give you another way to look at your debt, or your tax debt, or whatever, so that you can say, oh, well, if I do this, I can do that. But if this happens, and you have the whole picture.
That's right. I know I was doing somebody's tax return this year, and he comes to me every few years because he likes to file every few years, and he owed again, and he was getting all mad, and he says, I got to pay you to file, and I owe. And I looked at him and I said, it's not my fault that you continuously withhold a lot. And so you really have to have that come to Jesus moment, and like Esther says, you don't live above your means.
I mean, and if you do, then there's not too many options available to you. And sometimes the best lessons in life are learned the hard way, unfortunately. Many times those are the ones that stick with you the best, right?
That's right.
But again, if you're in that situation, you can call EG Tax. We have our own very own staff of attorneys that will help file the offer and compromise. Chris and myself will. And if you really have had that really bad situation, we can help you to get rid of the debt.
That's right. That's right.
And what else we have?
I got somebody for you, Esther. This is Donna from Buffalo. I was supposed to get a $1,500 refund from New York, but instead they say they want proof that my daughter lives with me, and they are holding up my refund now. Any advice?
Yeah, prove that your daughter lived with you.
Yeah, so
you have to, if you claimed the dependents on federal and the state, and they're asking for proof, then that's what you have to provide. What kind of proof would they provide? School record?
So it would be a record from the school that has your address, that matches your address, that was the address on your return, the address of record, or a letter from the doctor's office, or a lease that has your address with your child on the lease. Anything else you can think of?
No, I mean, you got to the lease, the doctors, the school records,
And
something.
then the residential parent, if there was a divorce, you'd want the legal document that says that she's the residential parent.
Right.
Right?
The odds are the other person probably claimed your child, and they just want proof that it's sorry,
Bless you.
your turn to do that. So you got to get them. Unfortunately, it's like when they send out the letters to do the W-2s. We need proof of the W-2s. You got to get them.
In the state of New York.
There was somebody who was referred to me, and I was doing her tax return this year, and she handed out these letters from New York. And so from 2012, 13, 14, over and over and over again, for the last few years, they had asked for her to prove the residency of her children, and she didn't do it. And so the sad thing is 12 was a dead year. There was nothing we can do, but she did bring me in the proof for 13, 14, and 15. And so sometimes you just call and make a phone call because we really, really want to help.
And that's the sad thing is that I was talking to somebody the other day, and he said, well, I just don't know what to do. And the one thing you can do is call us, because even if we can't help you specifically, we will put you in contact, whether it be an attorney or whatever it would be, or a financial planner, to help you to make sure that you get your financial situation or tax situation straightened out. And the call is free. And that's what we want to do. We just want to help. Right?
That's exactly right.
I'm Esther Gullius, the tax lady from EG Tax. Our office is open. We close all of our branch offices and go to one corporate office and 2475 Niagara Falls Boulevard. And that office is open 9 to 5, Monday through Friday. We're not open in the evenings or Saturdays unless by special appointment. So if you need help, if you're getting letters, come to see Auntie Esther and the gang here. And what we're going to do right now is we're going to take a short break for the news, and we'll be back on the other side. Thanks for listening. Hi, I'm Esther Gullius, the tax lady from EG Tax, and we're here to talk about your emails. We're not taking live phone calls today. We just chew up emails like 3 or 4 times a year, and that's what today's show is all about. So if you're somebody that has one of these burning questions and you don't want to be on the radio live, great way to do it is go to our website at egtax.com and just click on Ask the Tax Lady, and we'll answer your questions in the meantime. But we may use your question on the show too. So again, next week we'll be back with live phone-ins. But this week it's an interesting way to do the show.
I love when we have clients in front of us and they go, I listen all the time, especially before church, on the way to church, and I always want to call, but I'm afraid.
Yeah.
You just use a fake name.
I love, that people don't know how much we love the phone calls because, everybody has their own unique twist on things. And it's the twist that makes it so interesting, or sometimes people say, I don't know why you didn't just slap that person in the head. So anyway, okay, let's go back to our questions here. What do we got?
I got Peter from Wales. He says, EG Tax, my wife just passed away over Christmas.
Oh.
And last tax time I got a refund. I'm wondering about next year. I have 2 kids, age 16 and 12, living at home. Should I change my deductions at work?
Oh, that's so sad. Well, in the year of the death of a spouse, they're going to file a joint return. Right. The 2 years after the death of the spouse, he can still file qualifying widower with dependent child because the kids are still in his household.
Right.
So he's still going to get the benefit of the same tax bracket as if he was married filing a joint return. The only thing he's losing is the wife's personal exemption of 40/50. Right. So if he were in the 15% bracket, we're talking about a $600 reduction in his refund. Right. So if you got a $3,000 or $4,000 refund, that your refund's just going to go down by about $600, everything being equal.
And then I was wondering if his wife worked, and if she worked, there's going to be less income in.
That's true, and maybe they'll get an income credit.
Exactly.
Who knows? But it doesn't look like he has to. I mean, I think he probably just wants to adjust.
Right. It could have been maybe she was sick and she was on Social Security, so maybe the refund would go up
higher.
because of the Social Security.
That's true.
That's where, you got to come in and we'll sit down and run the numbers for you. And like you said, he'll be qualifying widower for 2 years.
And then the other thing is medical bills are deductible in the year paid.
Right.
So in the event that your wife was sick and the medical bills, you said she died last February, if the medical bills are now coming in, because you know how those things come in, they're so weird, and you're paying them now, try to front-end load them if they're substantial. If it's going to be, if they're more than 10% of your adjusted gross income, then you'll get that as an increased itemized deduction too. So all those kind of things. If you want to come in, we got the coffee perkin this time of year, and we'll just sit down
And then also I wanted to say that the one child is 16, so they're going to turn 17 soon. So obviously, so don't forget that the year that they turn 17, you lose that $1,000 child tax credit.
And on the state of New York, you also lose
the Empire. So
Right.
don't forget that. You were going to say
I
something.
was, and also now because if his wife passed away, he'll get Social Security for his children. That does not go on his return.
Right.
So
Right,
that
assuming that she were on Social Security.
on Social Security.
Right, if she
Right.
weren't, though, then you wouldn't
I
get it.
think depending on the amount of quarters she worked or
Right,
something.
right. But the thing, but that's something to look at. He should call Social Security and make sure
Yeah.
that the kids wouldn't qualify if she
That's a
wasn't
good
on
point.
Social Security.
Right.
The other thing is, many times people who become sick quickly and, don't realize that they can go and apply for Social Security disability. One of my clients last year got I think he was having like a heart problem, had a bad seizure, but then he recovered, but then they discovered that he had a heart problem. And so I said to him, you need to call Social Security and get Social Security disability. And he says, no, they'll turn me down. Well, he went right down to Social Security that day, brought all the medical records, and he got a check in like a month.
Wow.
So that's kind of good news and bad news, because if you get it that quickly, it means that you really do have a serious medical problem. But obviously, if you have a medical problem, Social Security is there. If you paid in for at least 40 quarters, it's you paid in, you're entitled to it. So make sure you go, and you don't always need an attorney is the point.
Yeah. Or how about how many? I know you had a couple this past tax season. I know I've had some where you have a married couple, and the wife, normally it's the wife, is collecting off of her Social Security instead of off of his. And they could be getting more money each month.
Right.
But they
And
weren't
they
aware.
never knew that they could. And, of course, Social Security is not going to say, Esther, do you know you could have?
Well, I had a client, they were both over 65, and he was collecting Social Security. So I was doing the tax return, and I said, can I have your Social Security statement? And she said, no, we get ours jointly. So I don't want to be rude, but I'm doing the tax return, and I'm thinking, they want to get it jointly. What do they say? So then I said, I don't mean to be rude, but what do you mean you're getting it jointly? They said, well, he has it all in his. And I said, no, you get like half of his. And he says, yeah, but then I'll lose half. And I said, no, it's you keep your 100% and she gets half of yours.
Pretty cool.
Oh, so I haven't talked to them since tax season, but really they were going to get like an $18,000, $18,000 a year raise in income.
Yeah. And I had somebody, actually I did that last year with somebody, and they actually ended up Social Security retroed it back.
No.
So they got a nice check.
Chunk of change.
Yeah.
So again, and that which just brings me to another thought, not just the emails here, but if you're somebody that's wondering about, should I wait till I'm 65 to collect? Should I wait till I'm 70? Should I collect at 62? How much do I have to make before I have to start paying it back if I'm under the age of 65?
Chris did a cool spreadsheet.
I know we have it on our. Do we have it on our website yet?
It should, yes, it's there.
Yeah. So on our website, you can go and determine how much you'd be losing if you don't collect your Social Security early, and all the different parameters, waiting till 66, waiting till 70. Okay?
Yep.
All right. I think we beat that horse, didn't we?
We did.
We got here.
We did.
My mother just told me that she owed $2,000 this year to the IRS. Normally, she owes around $100. She said nothing's changed. She has her pension, Social Security, and her gambling winnings. Could this be right?
It's so
Jenny.
funny. Somebody just called into our office not so long ago before we answered Jenny, and they went to another firm, and they said, my refund is so different this year. And so we looked at it, and the other firm forgot the 112R, which is the taxes that they paid to another state. So when that happens, your antennas should go up
That's right.
and say, wait a minute, what's
Well,
going on?
it's really interesting. I always tell the staff when we're training them, if a client is too happy or too sad, you better double check your work. Right. So if the client falls off dead on the chair, you better double check to make sure you didn't add input wrong withholding. Or if they're really happy and saying, let's go to Acapulco, I'll pay.
Right.
Then you better look because something isn't right.
Because the truth is, New York State won't let you know that the math was wrong.
Well, tell everybody what a 112R is, Tiff.
That is a credit for taxes that you pay to another state. So, for instance, I do this person, and she's a vet, and sometimes she's goes and works temporarily in another state, Pennsylvania, and so she has to pay taxes to Pennsylvania, and so we have to do a Pennsylvania return, and so the taxes that she owes, that she pays to PA, is a deduction on
Actually,
the New
it's a
York
credit.
A credit on the New York return. Yep, it's called the 112R, and so that's something you really want to look at if you pay taxes to another
let's say you paid,
area.
Say you paid PA $2,000.
Right.
Then you do the 112R and you get like a $2,000 credit on New York State.
Right.
So that means that it's not double taxation. A lot of people say, oh, then I'm paying twice.
Right.
You really aren't. On the New York return, you're getting a full credit for that taxes paid to
Right.
another jurisdiction.
Right. But going back to Jenny.
Oh, Jenny.
Yes.
Oh, that's the lady with the gambling.
With
Well,
the
you
gambling.
you
well,
know what
there, I
happened
think
there.
that's the issue. I
Security.
think Grandmom won a little bit more than she used to, hit a bigger jackpot, which made more of her Social Security taxable.
Right. And
So-
that's another thing that I try to show people I'm doing their tax return now. I'll say, now, see on line 21, the $15,000 you won at gambling, and see the Social Security number. Now, if I take out the gambling, what happens to your Social Security? And they'll say, well, it's not taxed. Right, but when I put the gambling in, you pay at 85%. Now, you didn't get any more money. They just tax you differently.
Right.
And so that's why seniors ought to stay out of the gambling.
But don't
casino.
they normally then go, but I have the losses to offset my winnings, so it shouldn't help. It shouldn't hurt me.
Different.
Yeah, it's not how it works. Line 21 is where the income goes, and the deduction for the money you spent gambling is an itemized deduction, not subject to 2%. But if you can't itemize, you get the old shaftaroonie,
Right.
right?
That's exactly
So
right.
don't go to the casino. Don't go to the casino. All right, what do we got?
I got Larry from North Tonawanda. I'm really hoping to have my son go to college next year for free, but our income is more than $100,000 threshold by $8,000. What can we do? Any suggestions? Larry from North Tonawanda.
Well, I know this is going to be a big thing, because
Right.
100,000 is the entry level that they're saying adjusted gross income, but nobody's really said whether it's MAGI or AGI. Right now, everybody's saying AGI.
Right.
But assuming it's AGI and they got 108,000, then what this couple needs to do is move more money into sheltered things such as 401k plans or
An
403bs, HSAs, right?
That's exactly right.
So that they can get rid of $8,000 worth of income that would have been on line 7.
Right.
And is it going to be also, like we said, we don't know the details yet, is it going to be like the health insurance, where if your dependent works, you have to add their income into
right.
it too. So he may be over 8, but if his son works and makes 8,000 also, they're really 16,000 over. Right. So,
all right, but here's the thing. A lot of times I'll say to people, so why don't you load up your 401k plan and so I'm saying let's put 24,000 away. And they say I don't have 24,000. So you have to take a look at what you're saving in this education.
Yep.
Right? If you're saving 10,000 in the education, right? What you need to do is maybe look at putting money, maybe borrowing money from your home equity to fund that 24,000 because you're saving 10,000 in education, and the amount of money that you're spending on mortgage interest is not going to be anywhere near that. So, Anyway, but you know what we got to do? I got to take a short break. We'll talk more on the other side of our break about the state of New York free education. I'm Esther Golias, the tax lady from EG Tax. We're going to take a short break. We'll be back on the other side. I'm Esther Golias, the tax lady from EG Tax. We're here talking about your emails, and we were just specifically talking before the break about state of New York free education. So you want to make sure if you got kids that are pointed towards going to college and you want to get the free tuition. I understand it's only tuition, obviously not room and board.
Right.
You want to make sure that you qualify, and sometimes all you have to do is modify what you're doing. So like we were talking about putting money, $24,000 away. I'd borrow the money, because if you borrow the money, if I had to borrow $20,000 on my home equity credit line, and I'm paying 3% interest, I'm paying $600 to borrow the money, and I'm saving $10,000 in tuition. So, and plus I got the money.
That's right.
I got the money in my 401k plan.
Exactly.
Right? So then at the end of school, maybe take it out and pay it off that way.
And that's when you talked about, Esther, just sitting there having somebody to bounce ideas off. So if you give us a call, we'll just bounce ideas off us, and we might have
if
suggestions.
They're going to come up with something that says that if you just recently got a divorce to get your AGI down. I don't think that's out of the question. I think many people are going to get a divorce.
Right.
Wow.
If they don't say that, I divorce my husband.
Here we go right here, the next email. I am a single mother of two and make around $25,000. My fiance wants to get married. I like my refund. Will it go away if we do?
Well, probably.
But that's where the tax planning, and that's where what we were just talking about.
True. I mean, people don't realize, and it really is unfair if you think about it. Here's people living together, right? He might be making 70, she's making 24, so they're making 94 together, but we don't count them together.
Nope.
We count them separately because they aren't legally married. And so she ends up with a great big earned income credit, right?
Yep.
Yeah.
And their kids would go to college for free. But the next door neighbor who's legally married, their kids don't go to college for free because they did the legal thing. That's really a problem. To me, it's a moral problem.
That's what they talked about, the marriage penalty, and there is a prime example of the penalty for getting married.
Yeah, but she would absolutely probably lose her income credit.
I know someone who's getting a legal separation, so they get a $25 a month health insurance instead of $800 a month for health insurance. So
under Obamacare.
Yeah.
That's
So it's
problem.
terrible.
And that's what's happening, and that's why having somebody to bounce things off of, you can look at. It's like playing pool, quite frankly. You hit the ball over here and this bumper over here, and it hits in the side pocket. I mean, the way you do your shot can have a lot to do with what's deductible. Not all income. Very little income on the tax return is all taxed the same. Wages are not taxed the same as capital gains. Rental property is not taxed the same as self-employment income. There's all these different kind of taxes. Your Social Security may or may not be taxed, and some of this tax-free income, like you would think that Social Security might be, is affected by things like gambling. Right. So it's really good to have somebody take a look at it.
If you don't know the tax law and the consequences, it's like walking around in the dark with the lights off, obviously, just stumbling around. You just really got to know the law.
And it really has nothing to do with what you do at tax time on your software. Because when you're done with your software, you don't even know if you have. I had a client that came in this year, and he had this adjustment to an IRA. And I said, so are you putting money again in the IRA? Because he had his TurboTax from last year. Are you putting money back in the IRA for your non-working spouse? And he said, I never put money in last year. And I said, well, your tax return says you did. And he said, I never. He said, when you do these things, you don't know what you're doing. And I said, yeah, that's exactly right.
Well, it's so funny. I got Warren, not Warren Buffett, but Warren from Amherst. It says, tax lady, I use TurboTax normally to prepare my return. And this was all not intentional. And my wife and I file separately because she wants her own refund. My boss says we really could be costing ourselves money, and I've been wondering if he's right. How can I be sure?
have us look at it. Bring both
Exactly.
those returns in. You have to do them jointly and separately. And if there's no reason, if you're saving money filing jointly, there's no reason why you would file separately unless you think the other spouse is cheating.
Yeah,
Right.
because the truth is you can amend a return to make it joint, but you generally cannot amend a return to make it separate.
Not generally. You can't.
Well, unless it's before the filing deadline.
oh, okay. That's true.
Right.
The filing
And
deadline.
I guarantee you, the way that sounded was she likes her refund. Well, if they file joint, would the refund get seized to pay a debt?
Oh, well, that's true. He might be somebody with
Child
a debt.
support or
Right.
something.
But then you do the innocent
Exactly.
spouse,
Yep.
injured spouse.
And another thing that I use this form all the time in 8888. It's an allocation of refund.
go.
And so if she wants her portion of the refund, it goes into one bank account. There's room for like 4 bank account numbers on that
It's so
8888.
cool. Our program shows you just how much what the
Right.
liability is and who had what withholding, and you can say, okay, Warren, this much of the refund is because of you, and this much is from your little bride, and if you get more money, that means she gets more money.
Right.
And many times, I'm surprised at so many families that don't do things like it's a joint bank account, like she pays her bills, he pays his bills. Back in the olden days, we put everything together. Back in the olden days. All right, what else we got?
You got something, Chris?
Sure. After I filed my tax return this year, Esther, I received a corrected 1099 statement from my brokerage account. I can't figure out what changed. What should I do, Erica?
Should look at it.
Let us look at it.
That's
Yeah.
Send it over.
Because they don't send a corrected one out unless there's a correction, and so there's a correction there somewhere.
And sometimes it might be just a very small correction, and it won't change the tax return. You don't have to do anything. But you want to make sure that if a corrected 1099 was issued, that you deal with it, because this is going to the IRS, and they could send you a bill.
And I can't tell you, we were just talking about people doing their own return. And those brokerage statements, there are several pages, like Smith Barney. There's a 1099 INT, a 1099B, a 1099 DIV. And I can't tell you how many people do their own return who don't flip it over and look at the 1099B for the sale of stock. And so the IRS will send you a letter like a year later and say that you got this letter saying you owe $7,000 because they won't put the cost of the $8,000 stock sale. And so there's always a cost attributed with it. And so you have to do the Schedule D.
Right.
And so,
Right.
Or how about the, I don't want to say hidden, but basically they are tucked away in there, the brokerage fees.
yes.
People don't understand where they could go. Or even the foreign tax credit right on the 1099 DIV. Well, it didn't ask me, so I'm not going to use it. Well, that foreign tax paid would be a credit on your tax return. So even if it's $40, you just lost $40. If
right.
you didn't, I could use $40.
Right.
Well, and that's what's so interesting is garbage in, garbage out. They've always said that about when you're using a computer. If you don't put in the correct information, you're going to get the wrong information. It may be mathematically correct, it just isn't the best answer for you or the most complete answer. So you want to make sure that, and this is a great time of year to bring in your brokerage statement and bring in your completed tax return, and we can take a look at it and see if we can't, if it was done correctly. Because you don't want to get the letter. The letter is not the most preferable way of dealing with your tax situation.
Yeah.
All right, what do we got?
And I'm sorry for stepping on you. I just wanted to say before we leave off the topic of married filing separate, if you're itemizers and you had a big medical bill or you had another large transaction, you might want to explore the notion of married filing separate. So it's not something that's not always on the
married
table.
filing separate many times works.
Right.
Most of the time it doesn't.
Right.
But every once in a while, if you have large medical or large employee business expenses, married filing a separate return is better than married filing a joint return.
Were you
Right.
going to say something, Chris?
If
you remember.
And I can't remember now.
My
Way
fault.
too young to have that problem, Chris. All right, what do you got? One more here?
I do. I just got Tom from Kenmore. We just sold my mom's house in March for $120,000. My sister and I were gifted the house in 2009 when our dad passed away. How do we make it tax free?
Now you can't make it tax free now.
Well,
It's too late, baby.
Wait.
Yes.
It was gifted when he passed away.
All right, so Dad you get a stepped-up basis.
Right.
from
If it was
Dad.
an inheritance,
Right.
I mean, gifted
On
and
half.
inheritance is different.
Right, but
So-
if they'd get a stepped-up basis for Dad's half, and then the rest of it would go back to half of Mom's
If
basis.
Mom was still alive.
Right.
Right, so half of it. But they can make sure that they tally up all the receipts and make sure that they add up all the improvements if they have it. I mean, that's...
And here's the thing:
I know.
if you have been gifted a house or any asset for that matter, while the gifter is still on this earth, it is really in your interest to have that kind of a conversation with them and say, Mom and Dad, what did you pay for the
Right.
Disney stock?
Right.
Mom and Dad, how much did you pay for your house? What are the improvements you made to the house? If they're gifting it to you, in the situation of a house, though, a life estate is the best way to go.
What were you gonna say?
Right. I was going to say, I know how to make it tax-free.
How?
Well, what is the rules of selling a house?
2 out
You
of
have to live in
5.
it. 2 out of
Sell
5
your
years.
house you live in now,
That's true.
move into Dad's house.
But they said they already sold the house, Chris.
Oh,
But
I'm
that's
just-
true.
But that
But
was
it is
really
true.
that's
a
good
great point.
That's a
that
good point.
For those of you that have gotten a gifted house and you want it to be tax free, all you have to do is move into it for 2 out of the next 5 years, and then if the gain is less than $250,000 and you're single or $500,000 married filing joint return, it would become tax free. But in this case, they had sold it already.
Right.
So, but it was good thinking. I love that when you think so much like that, Chris. All right. Well, this week's show is almost over. And, of course, if you're getting a love letter from the state or the federal, come see EG Tax. We want to help you. We will go all the way up to tax court with you if you're right and you need defense. We're very happy to help you. EG Tax is there Monday through Friday, 9 to 5. Go to our website at egtax.com. Ask the tax lady. Anything you need tax related, we're there for you. I'm Esther Gulius with Christopher Fabian and Tiffany Fabian. See you next week. Bye-bye.